Hey, it's Cashflow Mike, and today I want to talk about one step-by-step method to mastering cash flow in your business. So let me tell you that most business owners believe that if they sell more, that their cash flow problems are going to be disappearing. That's not the truth about cash flow, right? It's far from the truth, but here's the truth. Revenue doesn't fix a cash flow problem. Revenue is just a measurement of how much work you did. That's it. You can't spend it. Gross profit is the most important number that's on the income statement. It is the only place that you can get cash to spend or put in your pocket. And I've seen businesses doing millions in sales that still struggle to pay their bills. And it's not because they're not making enough money. It's because their cash flow timing is off and they don't know where the money is going. So today, I'm going to show you exactly how to take full control of your cash flow. And we're going to break it down into 4 steps from the Clear Path to Cash framework. So here's the 4 steps that I'm going to go over. Step 1 is, hey, we need to find out where that cash is leaking. And we use Mining Your Business for Hidden Cash to be able to do that. Step 2 is that I want to speed up the cash cycle, the cash conversion cycle, by optimizing it with the fast money formula. Then step 3, I want to understand how debt fits into the plan using the home run financial system, right? So once we find out, do we need a loan? Do we not need a loan? Can we fix it ourselves? We're going to look at the home run financial system and see if debt fits into our plan. And then step 4, I'm going to use forecasting and forecasting by the number, specifically building a cash budget in order to avoid having this problem ever again, right? So those are the 4 steps. So by the end of this, you're going to have an exact plan on how to improve your cash flow, and no guesswork is going to be required. Are you ready to get started? So first of all, let's talk about where is your cash going? And I use Mining Your Business for Hidden Cash to do that. Now, Mining Your Business for Hidden Cash is about looking where cash is leaking out of your business. It compares you in a couple different ways. Your current performance, I compare it not only to your own goals, which is what I say you could be, but I also compare you to the industry averages, which means what you should be, right? So when I think about it, it's what you should be versus what you could be. So let me introduce you to Sarah, right? I mean, here's one of my clients, Sarah, who runs a growing retail business. And man, she was making sales every single day, but always felt broke. So when we dug into her numbers, she had over $150,000 in missing cash or hidden cash. It wasn't stolen. It was just lost. It was leaking out of her operation. And this happens in almost every business. And that's why we start Mining Your Business for Hidden Cash. It's how to find cash leaks. You got to ask yourself, how long does it take for customers to pay me? Am I paying suppliers too fast? Faster than I'm collecting from my customers? Do I have money tied up in inventory, like slow moving products or any unnecessary expenses? Am I pricing my things correctly? What I do is I look at your numbers 2 different ways. I say it's vertically, which are cash generating activities, starting with sales, subtracting things out until we get to profit, and then cash conversion activities, which is how long does it take to do it? So it's a horizontal. So it's looking at your business from 2 different directions. So for Sarah, the biggest leak in her business was her accounts receivable. Customers were taking 60 days to pay, but she was paying her vendors every 30 days. So here's how we fixed it, right? First of all, what we did is we shortened her payment term. She did go from net 60 down to net 30, and we started to do automated style of reminders. Even something as easy as an automated reminder every week or so past the due date helps people get that little bit of a nudge to paying your invoice. Then we also started offering early payment discounts. We did the common 210 net 30. That means we gave a 2% discount if you paid your bill within 10 days. Otherwise, we would allow it go to net 30, but you did get the 2% discount if you paid it within the first 10 days of the invoice. And she actually started enforcing a late penalty to her customers that were dragging it out. She had it on the invoice. It was listed there that there would be a 2% fee for late payments, but she never enforced it, right? It was one of those things that was for looks only. Maybe it was a deterrent, but it was never enforced, so it wasn't looked at very seriously. But within a few months, she had freed up about $50,000 in cash. So think about that. Just a couple of months, changing just the way that we operated slightly on how we collected money, she was able to free up about $50,000. So here was my key takeaway from that. You don't have a cash flow problem until you know where your cash is actually going. You got to find the leaks first. That becomes the problem. So you might feel, you might think, but you got to know exactly where that's coming from. And you can do that using Minding Your Business for Hidden Cash. So number two is what we want to do is speed up the cash flow. We want to use the fast money formula to be able to optimize. What levers can I pull to be able to bring in cash faster or move money faster? I used to call it the speed of cash. And the speed of cash is how fast do we want money to move through our company? The other thing about the fast money formula is that it helps you calculate what your financial gap is. Every company has a financial gap, and that's the difference between the time it takes for money to come in and the time it takes for money to go out, right? The difference between those two numbers equals the financial gap, and your working capital is designed to cover that amount of time, right? So that's, if you don't have enough working capital, that's where your line of credit comes in. So once you know where the leaks are, the next step is to optimize, how your cash flow cycle works. The fast money formula is about speeding up how fast cash moves through your business. The faster you turn sales into cash, the more control you have. So I was working with a manufacturing company, and they were growing fast, but still running out of cash. What was the problem? They had too much money tied up in the inventory, right? They weren't turning their products fast enough. It was sitting there in the warehouse. And I'll tell you, every time I've talked to a client and I take a tour of their facility, the first thing they want to do is show me the warehouse. And guess what? In the warehouse, they open up the doors and it's almost like some magic glow comes out of it. Oh, look at all my inventory. I don't see it as awesome. I see it as wealth on the shelf, and it shouldn't be there. So how do you know that it's been there too long? Very simply, walk the warehouse and blow on the top of the box. If it's dusty, it's been there too long. You need to figure out ways to move that. So here's what we did. We ran them through the fast money formula. And by doing that, I was able to determine that it was the inventory. We found the proper levels. So we reduced inventory waste by tracking only the high demand products. We switched from net 45 payment terms to net 15 to speed up collections just a little bit. And we offered some payment terms to customers to help pay sooner and in installments, right? But the biggest thing was determining the par level of each product that he had on the shelf. Par is periodic automatic reordering. And what that's saying is that in most months, this is how many pieces of a product or a piece of inventory I should have on the shelf, because if I have this much, chances are high that I won't run out, and I won't have too much. I won't have too little, and I won't have too much. Understanding par helps you know how much to reorder. That was one of the things. He would just reorder because it was on special. He would reorder because it was buy one, get one. But at the same time, it was tying up cash on the shelf because it wasn't moving fast enough. It's like me, back when I ran the bars, I bought a buy one, get one case of cotton candy vodka. And guess what? That sat there for 3 years because nobody was drinking cotton candy vodka. So I should have known better, right? But I didn't. How do you fix that? You figure out what it is and you reduce those levels down. You can do it through discounting. You can do it through clearance. You can give it away. You can donate it, those type of things. But getting that out of your inventory and trying to get some cash for it will help you manage the cash flow cycle of your inventory management system better. So these small tweaks actually freed up about $100,000 in cash just for this person by identifying which items we had to run down. So my key takeaway here in step number 2 is that cash moves in cycles. And if you don't control the timing, your business is always going to feel strapped for cash. That fast money formula is going to help you get paid faster and keep cash moving. So that moves me to step number 3. When you have a shortage, a cash shortage, that financial gap is too big and you might need to get a loan, you got to check, how well do I manage debt today? So we need to figure out when to use debt, how much to use debt, can I use debt, what am I going to be looked at from the bank? And I like to use the home run financial system to start this process. Because sometimes even after we optimize cash flow, timing issues still exist. That's where debt, when used correctly, can be a tool and not a trap. The home run financial system is going to help you understand when and how to use financing to cover those cash flow gaps without creating bigger problems. So I worked with a wholesaler who was growing fast, but they kept maxing out his line of credit. He was using short-term debt to cover payroll, rent, supplier payments. This is a huge red flag when you start using your line of credit to cover operating expenses. It's designed to cover your direct cost, like inventory, like payroll in a service type company. So here's how we fix that. First of all, we started matching our long-term expenses with long-term debt, right? So long-term debt is used to pay for all those items you can depreciate. Not doing that is called mismatch financing, right? It's like using the wrong loan product to buy something. I mean, you wouldn't buy a house with a credit card. Why? Think of the interest, right? Right now there's 27, 28, 29% interest versus a 7% mortgage. You will lose money. It will kill your company by sucking cash out of it in the form of interest. So using the right loan product to buy something is really important. And one of the rules I teach is that the length of the loan should match the life of the asset. So if you can depreciate something for 5 or 7 years, you should use a 5 or 7 year term loan to pay that. So when depreciation ends, so do the payments. The other thing we did with this is that we started using the line of credit only for short-term cash flow gaps and not everyday expenses. It was only for the inventory. That's the only thing we used that for. And how did we pay the line of credit? As soon as our customers made the payment for the product that they bought, part of the inventory that came off the shelf, we made the payment first to the line of credit and then used the remainder, the profit, the gross profit, to run the business. So make sure you're doing that. Use the cash conversion, the money the customer gives you, to pay your short-term credit payments first, and then use the remainder to run your business. And then lastly, we created a buffer by maintaining a 60-day. That's all the farther I could get him at first. I recommend 3 to 6 months, but at least we put in a 60-day cash reserve. How much? It's 60 days worth of operating expense. If it takes you $10,000 a month to run your company, you need at least $30,000 to $60,000. In this case, I moved him just slightly to 60 days because he had none to begin with. So that leads me to that key takeaway. Debt really isn't the problem. It's how you use it. When you use it improperly, it's going to hurt your company in the form of higher interest or more debt payments coming out of cash. So when you use the home run financial system, it's going to help you manage debt strategically instead of letting it manage you. And then the last step, right? The last step is all about forecasting cash flow. It's about building a cash budget. So now that we fixed the leaks, we optimize the cash flow, we manage debt properly, the final step is making sure that this never happens again. And that's where cash flow forecasting comes in. Most businesses don't plan ahead. They react to cash flow issues after they happen. But with a simple cash budget, you can predict and prevent cash problems before they start. You got to remember, most forecasts are only about the income statement. They do pro forma income statements. And when you hear the word pro forma and when you do your income statement forecast, a lot of times we miss those one-time cash expenses. My business might run, if I sell this much and spend this much, I'll have this much profit, but it doesn't say that I'm going to buy a truck. It doesn't say I'm going to upgrade my computers. It doesn't say all these one-time cash expenses that we make throughout the year. The cash budget helps you think through that process. So here's how to track your cash flow, right? Or forecast your cash flow. I want you to track any upcoming expenses. Pretty simple. Know what bills and payments are due that you have. Project your revenue realistically. And don't use best case scenario. Best case, worst case, most likely. Use worst case or most likely, because that way you're planning for being conservative. But when I say project your forecasts realistically, that means you got to account for seasonality. Just because you say, I'm going to make $1 million in sales next year, you can't just divide that by 12 and say, this is how it's going to come in. Chances are you're going to have some big months and you're going to have some less or slower months. Make sure you account for that in your forecast. Then what you want to do is be able to identify any cash shortages before they happen. It's like looking across the street or looking both ways before you cross the street because you want to see the bus coming. That's what forecasting is. It's going to tell you how far away the bus is from where you're trying to cross the street. It doesn't tell you how to stop the bus. It doesn't tell you how to make the bus turn. It doesn't tell you what options you have going across. Forecasting is just a piece of cash flow management, and you have to be able to see how far away the bus is because the closer it gets to you, well, the fewer options you have. So you want to be able to identify it farther down the road. So one of my clients was a service-based company, right? And we used this system and found out that we were going to run out of cash within 60 days. And really, that's days to bankruptcy. We're going to be out of money in 60 days because they saw it ahead of time. Because we were able to identify it, we were able to raise prices on some of our customers. We were able to negotiate some better supplier payment terms and spread out some big expenses, like moved them from the front of the year to the back of the year in order to avoid strapping the cash with less money to be able to make our bills. So here's the key takeaway. I want you to think about forecasting isn't just about predicting the future. It's about making sure you're prepared for whatever comes next, right? So here's the closing. I know we spent a little bit of time on those 4 steps, but in closing, I want you to think about taking action today. What are you going to do, right? So we covered a lot. We talked about how to find cash leaks using Minding Your Business for Hidden Cash. We talked about how to speed up cash flow with the fast money formula. And we talked about how to use debt strategically with the home run financial system and how to forecast cash flow so you never run into this problem again. But the big question I've got for you is, what's your next move, right? Pick one of these strategies. Just pick one. I suggest starting with Minding Your Business for Hidden Cash and finding where cash is leaking, but apply it this week. Make a change. Make a step towards improving your cash position in your company. And if you're serious about taking control of your cash flow, check out my Clear Path to Cash program. I not only teach you the math behind it, I've got the tools, the resources, the spreadsheets, the worksheets, the app that does all of this for you. So check out my programs at cashflowmike.com. You'll be happy you did. Your future self will be loving you at this point in time for making this decision. I'm Cashflow Mike. We'll see you next time.